Good afternoon, traders and investors. Will back here with another one, coming to you with a Thursday market recap. Hope all of you had a good day of trading today. And ooh boy, is it getting a little bit spicy in these markets, isn't it? So in today's price action, guys, we had a significant sell-off. The bears finally capitalizing on some weakness here. And the justification behind it all, it was not bad economic data. They blamed it on poor Microsoft and Meta earnings. Peculiar, because we went over those earnings on the channel yesterday, and they were actually fantastic. So just goes to show once again, guys, that earnings season are sometimes a little bit of a casino. Companies can have fantastic earnings, but if the stars align and the markets are looking for a little bit of a sell-off after 5-6 days of rally, 5-6 weeks of rally rather, they will profit from any opportunities, guys, to drop the markets a little bit, even though the data is good on the macro front and even though the earnings as well were good. Just a little bit of a technical correction in my opinion. And we've been anticipating this on the channel for the past 2 weeks of time at this point. So in today's video, guys, I have a few things prepared for you, of course. Number one, we are going to go over the PCE inflation numbers that came in early this morning. Quite good, as a matter of fact. Thereafter, we're going to take a look at some major earnings that I have prepared for you guys. 4 to be specific. Number one, we're going to go through, of course, Amazon and Apple. Thereafter, Uber. And lastly, to wrap it up, MasterCard. So decent little earnings presentations for you guys today. Thereafter, we're going to take a look at our major technical analysis on our major stock market indexes, see how we're shaping up after this massive 1 day's worth of decline. And lastly, guys, no portfolio update for today. That is going to be for tomorrow in the ending weekly recap for all of my trades. I made an absolute ton of trades today, took a lot of profits off the table, also opened some brand new positions as well, which I'm very excited for. So we'll have to see those tomorrow together on the channel. But of course, if you want to always see them in real time, the link to the Discord where I share them all is down below. So moving on in, guys, into the SPY. So SPY down about 1.96, QQQ down about 2.52. So in terms of the heat map, guys, you will see that it was not very pretty at all, right? However, it wasn't a broad market sell-off. A lot of the pain points were, of course, in big tech. Microsoft having one of its worst days in the last 2 years, but the damage was done pretty much across the board. Semiconductors selling off in a big way as well. Continuation from those AMD poor earnings, right? Take it with a grain of salt. And then to the bottom half of the market, financials down a little bit today. Healthcare very mixed, but still down. And the bottom half of the market, even though there was some green, guys, the pain points in the bright red can't be denied. Let's take a look at the 1 day relative and you will see it is also not very good. Utilities, the only positive sector on the day. Everything else to the downside. Of course, technology taking the largest bath of them all. And where do we stand on the 1 week relative, guys? Well, only communication services, only Google and Meta holding up some form of gains. Everything else, guys, is deep in the red. So suffice to say that our weekly consolidation that we've been waiting for in the past couple of weeks is finally upon us. So hopefully you've been heeding my non-financial advice and taking profits where it was due, saving your buying power to go shopping for some high conviction, high quality companies that are now coming into decent sale areas. So before we get into more technicals, guys, let us jump into those PCE numbers in terms of the inflation. And you will see they are actually quite decent. So here's your PCE, 2.1% in line with the estimate. Core, however, came in 0.1% higher than the estimate. But this overall inflation number, guys, is literally right at the Federal Reserve's target of around 2%. So not bad there. Consumer spending, we actually saw an uptick here, 0.5 versus the 0.4 consensus. And initial jobless claims coming in under the estimate. Jobs data for the week, for the most part, was mixed, but we don't see any major red flags. So we got the GDP, no major red flags there. We got the jobs data, no major red flags there. And now inflation, also no major red flags. Keep in mind, though, tomorrow, another big jobs report. And we also have the unemployment rate and the manufacturing index as well. So a little bit more data. And then next week, guys, we get into the Tuesday elections and the Wednesday rate cut. Let's take a look at some inflation numbers a little bit deeper, shall we? So in terms of the PCE, key inflation rate hits 2.1% in September, as expected, closing in on the Fed target. Let's move into where the inflation was. The move in inflation was tilted towards services prices, which increased 0.3%. That was in line with last month as well, while goods prices decreased 0.1%. For the fourth outright deflation figure in the past 5 months for the goods category. We've been noticing this in CPI, how goods have been in a deflationary environment. So prices are actually coming down. Maybe not down as quickly as we would like to see, but they are in a deflationary environment. Housing prices eased off their pace, rising 0.3%. Energy goods and services fell 2%. The big one is here, guys. The sticky inflation has been housing. And now that we're seeing a housing inventory buildup, lower new home sales, the housing market is starting to kind of peak out. And now we're going to start seeing rising inventories, possibly a lowering of rents as well, a lowering of home prices, which should in turn bring those sticky housing services numbers a little bit down further. Let's move into the actual report, shall we? So here is your PCE graph. This is a month over month basis. You can see that 0.3 is, or rather 0.2 is pretty good down here. Take a look at the goods though, right? Goods. Deflationary, this line right here is your 0, and we are still deflationary, guys. For pretty much the past 5 months, we have been net deflationary in goods, so that's always a good sign. Take a look at services. Although services do remain slightly sticky here at 0.3%, we can see that they're not expanding. And when we go into housing and utilities here, which is going to be the orange line, you can see that as well, we are not expanding. We're starting to slowly trend to the downside, which is a good thing overall. So I'm fairly pleased with the direction of this report. Now, in terms of your Fed rate probabilities, where does the Fed stand in all this? Well, the market still predicts a 96% probability of the Fed cutting rates by 0.25% at the next Wednesday meeting. So we'll take that one day at a time. But overall, fairly decent report, guys. No red flags in the macro, the many macro events that we've received over the week so far. Now, let's jump into the good stuff, shall we? Getting into our first earnings. And we're going to start off with a banger, guys. We're going to start off with Amazon. So Amazon, can they save big tech? Well, they're doing a pretty good job right now, up about almost 6% in the after hours. Take a look at their numbers, guys. They absolutely crushed it. The focus on Amazon, as I've mentioned the past 2 quarters, is their move towards cost control and efficiency. Amazon has never been a bottom line company. They have sought to expand top line revenues at all costs. But now in the past 3 quarters, they've been focusing on bottom line net margins and free cash flow expansion. It's not that they couldn't do it before, but now they are really focusing on that. So think of free cash flow buildup, think of EPS expansion, think of net margin expansion, all the good things that you want to see from such a mature company that has spent a lot on growth in the last 3-4 years, and now they're focusing on efficiency. So let's move into the earnings, guys. They absolutely killed it. Look at these numbers. 25% beat on EPS, absolutely massive, and a 1% beat on revenue, very good. Let's have a look. Amazon shares pop on earnings beat and cloud growth. And the numbers, guys, were fantastic. Better than expected earnings and revenue for the 3rd quarter, driven by growth in its cloud computing and advertising businesses. Here's the big number, guys. AWS, 27.4 versus 27.5 billion expected. Tiny little miss on AWS, but this is still fantastic growth. We'll get into that in a little bit. Advertising, 14.3 billion versus 14.3 expected, coming in line. So in cloud, AWS is growing faster than the same period last year. Sales grew 19% during the quarter compared to a year ago when sales were growing only 12%. AWS is still growing slower than its top challengers. Revenue from Azure, I'll start saying Azure. Somebody said, why do you pronounce Azure? Because in French, it's Azure. And obviously, as a French-Canadian native speaker and Azure being a French word, I kind of use the French connotation, but sorry, I'll start saying Azure. So revenue from Azure and other cloud services at Microsoft came in at 33%. And Alphabet's Google Cloud revenue increased by nearly 35%. So AWS, slightly lower growth, but keep in mind, they are the industry leader, guys. They command the most market share. So even though Microsoft and Google are growing at a faster pace, they're still not catching up to AWS's business. Advertising was another bright spot in the report, 19% year over year to 14.3 billion, outpacing growth in Amazon's core retail business. Now, take a look at this as well, guys. In terms of advertising, right? We're just talking about advertising right there. Take a look at how we've compared with all the earnings that we've received so far. Google was 10% up, right? Year over year. Meta, 19%. Microsoft, 18%. And Amazon competing with the best of the best advertisers in terms of their advertising growth. So Amazon looking quite good in that aspect. Let's move on further, shall we? Moving in, among online ad companies, Amazon showed the strongest growth, although its ad business still remains a fraction of the size of something like Meta and Google. Amazon forecast revenue in the current quarter to be between 181.5 and 188.5, which would represent growth of 7 to 11% year over year, which is very good. The midpoint of that range, 185, fell slightly short of analysts' expectations of 186.2. tiny little miss on guidance for revenue by about 1%, guys. Microsoft as well had a tiny miss on revenue for next quarter by 1.8%. The stock's down 6%, but keep in mind that miss from Microsoft on revenue is not because demand for their products is slowing. They are constrained for supply output, guys. They have too much demand, and now they have to kind of catch up on production. So that's the best case scenario for Microsoft, right? Operating income during the third quarter grew 56% year over year, showing that Amazon's focus on efficiency and continued cost cutting continues to lift the bottom line. Amazon CEO Andy Jassy has been laser focused on trimming expenses across the company, cutting more than 27,000 jobs since the start of 2022. And that's going to be the focus of today's report, guys. The net income. Are they expanding free cash flow? Amazon's never been a free cash flow juggernaut and has never been a company that focuses on net margin. Look what happens when they actually do, because they can. Look at this, net income, $15.3 billion. That is 9.6% in net income. Where does that stand in terms of what they've recently been doing? Well, I'm glad you guys asked. Look at this margin expansion. Not only are they expanding gross on the top, operating margins, highest in the last 10 to 15 years. And look at these net margins now, 7.35 last quarter. And I just showed you guys, we are currently sitting at 9.6. This is the best net margins Amazon has ever recorded, guys, in the last 15 years. So suffice to say, they are driving money to the bottom line. Watch out for Amazon, guys, because they have so much net income potential. Free cash flow increased to $47.7 billion for the trailing 12 months. Last year's 12 months, 21.4. Look at this free cash flow expansion, more than double, guys. Just goes to show when they want to, they can be a cash flow absolute monster. Moving on further, a couple few headlines. The Prime Day, was it a good Prime Day? Yes, record sales, record number of items sold, record Prime member participation, and they saved customers more than $1 billion. That's crazy. And they also announced plans, this is interesting, to expand Amazon Pharmacy same-day delivery of medications to nearly half of the US in 2025 by accelerating the rollout of new pharmacies in 20 more US cities by the end of next year. Watch out Walgreens, watch out CVS. Amazon is coming for their business, guys. Pharmaceutical business for Amazon doesn't often get talked about, but it's going to be an absolute monster as well. All in all, very pleased, guys. And this is the numbers that I want to show you, right? Look at this net income expansion. When they want to, they definitely can, right? North America segments are doing quite well. International is also doing quite well. But what I'll focus on is the free cash flow. Look at this net increase in free cash flow year over year. Look at these quarters, guys. These quarters are absolutely massive for Amazon. So looking very good in that respect. They have not started buying back shares just yet, but as they grow free cash flow, as they expand net margins, where do you think that money's going to go? They've already expanded their retail facilities, guys, in 2020 and 2021 when money was cheap, when interest rates were cheap. They took out a bunch of loans. So now they're going to start paying down their debt. And now they're also probably going to start doing buybacks, not for in the foreseeable future, but think maybe second half of 2025. I would not be surprised if that's coming. So masterclass of efficiency put on by Amazon right now. Where do we stand in terms of the valuation? Well, decent valuation, guys. As we stand right now, the revenue growth is 10.6% per year, EPS growth of 26% per year. And what I want to show you guys is just watch this margin and free cash flow expansion, right? The debt was piled up while they were expanding their retail business and AWS facilities. And now they're generating a massive amount of free cash flow. They have a ton of cash on the balance sheet already. They're going to start paying down debt if they need to and possibly look to deliver some buyback. So that is possibly coming for Amazon. Look at this EPS growth curve. When they want to focus on profitability, guys, they can do it. There's your EPS expansion curve. And look at this revenue expansion curve too. Amazon, an absolute monster in the industry right now. So at 194, where do we stand in the after hours, right? It's 196 now, but you guys get the drill. 38.5 forward PE, but when you divide that by their massive EPS growth rate, we get the PEG ratio. Anything under 1 is good, above 2 is slightly rich. 1.48, it's right there in the middle, which is fine for me. And free cash flow yield, which we never used to look at Amazon because they never used to have much free cash flow, is now up to the minimum of our range, 2.4%. We usually look between 2.5% to 5%, but this is not known to be a more defensive free cash flow company. So for them to already be bringing it up to 2.4, that is quite good. I like Amazon right here for the long-term portfolio and also for some possible swing trades to the upside, guys. I would not be surprised if most of these analyst targets are filled over the next year, talking about in the mid $200 range. Would really not be surprised at this point. We'll do more technical analysis on Amazon in the technical analysis portion of the video coming up in, about 10, 15 minutes after we get through these earnings, right? So that's everything for Amazon. Now, let's get into massive company number 2, which is going to be Apple. So Apple coming down after hours about 1.42%. And Apple, as a matter of fact, they had very mixed earnings, but I was expecting a lot worse from Apple, guys. So they had a miss on EPS by 40%. This is because they settled a lawsuit in the European Union dating back from 2016 for about $10-11 billion. So this is what took their unadjusted EPS, right? If you take it on an adjusted basis, they actually beat, but this TradingView number is encompassing for that one-time charge of $10 billion. Other than that, they would have beat EPS, and revenue is up by about 0.44%. So let's have a look at what exactly happened with Apple, and it really was not as bad as I was expecting. So Apple sales rise 6%, company seeing early iPhone 16 demand. So putting all those demand concerns once again to rest. That's 2 quarters in a row where people are scared about iPhone sales, and the iPhone sales come in over the expectation. I don't know if Tim Cook is buying 5 million of these a day himself, but they're somehow beating the expectations, right? So you can really never trust what other analysts say. Apple has the true numbers, right? So fourth quarter results beat Wall Street expectations for revenue and EPS, but net income slumped after the company paid a one-time charge as part of a tax decision in Europe. So moving on, iPhone revenue. 46.22 versus 45.4 beat. Mac revenue, slight little miss, but it is coming up quarter over quarter. We were noticing a slump in Mac and iPad in the last 2 quarters. They're now coming up. Even though they missed the estimates, they are coming up from a cyclical bottom. So Mac, miss. iPad as well, miss. Other products, so wearable, the AirPods, the Apple Watches, the Vision Pros, all that other stuff, right? 9.04, slight miss on wearables as well, or other products as they call it. Services, which is supposed to be a highlight for the company, also missed the expectation, but the expectation was slightly high. When we look at the services growth rate, we'll see that it was actually quite good, and they found a way amongst everything to pump out higher margins. Leave it to Apple to pump out good margins, despite being slightly weak in a few of their segments. So iPhone revenue grew 6% in the first sign of how the iPhone 16 is faring to the market. Keep in mind, Apple only had 1 week of iPhone 16 sales for these quarterly numbers, right? That's when the quarter ended. They only had 1 week from the time they released it until the end of the quarter. So we'll get to see more about the iPhone 16 sales in this current quarter, right? So it's still Apple's most important product, accounting for nearly 49% of the company's overall sales. Sales of the iPhone 15 were stronger than the 14 in the year ago quarter, and 16 was stronger than 15, said the man himself, Tim Cook. We're getting great feedback from customers and developers talking about Apple Intelligence, AI. We're getting great feedback from customers and developers already, and a really early stat, which is one of only 3 days worth of data. Users are adopting iOS 18.1 at twice the rate that they adopted 17.1 in the year ago quarter. So people are very, very anxious to try the Apple AI service. Now, in terms of what they're expecting in the future, low to mid single digit sales during the December quarter. That's pretty much standard with what they've been doing, right? 4 to 5% perhaps. Now, moving on further, Apple reported $14.73 billion in net income. So as you said, it's 15.5% without or with the one-time charge. We're used to seeing Apple net margins in the, let's say, 25 to 30% range. You can see on an annual basis the past couple of years, they're usually between 25 and 30% at the high end. So for them to come in slightly under, that's because of the one-time charge. Without the one-time charge, it's 26%. In line with what they've been doing, so nothing to see there. Now, moving on further, see, adjusted EPS, if you remove the one-time charge, was actually up 12% on a yearly basis. Revenue rose about 2% for the full fiscal year, and its cash pile now stands at a cool $156 billion, guys. So they have money to weather any type of storm whatsoever. And finally, putting in 2 quarters of back-to-back growth. We've been nervous about this, right, in the past year and a half, and now Apple growth rounding the corner, right? So we're coming into that cyclical bottom. There was a lot of brought forward demand when money was free, when interest rates were cheap, when everybody had stimulus check money, everybody was buying iPhones, everybody was buying iPads, AirPods, everything you can think of, right? MacBooks. Now demand has normalized for those products as people pull back on spending with high interest rates. And now, as we kind of see the soft landing scenario shape up, consumers are starting to spend again because not many people have lost their jobs And the wage growth is still outpacing the level of inflation. We look at that every CPI every month, guys, and wage growth is outpacing inflation. I know it doesn't feel like it because the pace is slow, but it is still outpacing. You're not losing any more pricing power, essentially, right? The iPad business had the strongest growth of any of Apple's hardware lines, 8% up. The Mac business, 2% up. Sequentially growth. The growth was driven by sales of the MacBook Air, which was updated with new chips in the spring. The services business, right? iCloud, Google Search revenue, Apple Care warranties, remains a juggernaut and grew 12% on an annual basis. So they missed the estimate, but still very nice growth. Apple also faces competition from local Chinese handset makers like Huawei. That was a big concern. So we'll see how that rolls out in the next year. Apple's revenue in China, Taiwan, and Hong Kong was down slightly year over year. Now, the company said it had spent $29 billion on share repurchases and dividends during the quarter. You might remember 2 quarters ago, they authorized $100 billion of buybacks, and they've gone through essentially almost half of that right now. So they still have a cool $50 billion for buybacks, but they're sitting on a ton of cash. I wouldn't be too worried about the company. Now, in terms of their trailing 12 months free cash flow, guys, look at this. This number is crazy, right? Trailing 12 months free cash flow is about $108 billion. You just take your operating activities cash, you remove the property and equipment purchases, right? A few miscellaneous items as well. But it's about 108 billion. How does it fare in terms of Apple's free cash flow in the past? Well, you can see on a yearly basis, they usually bring in anywhere between, in the last 3 years at least, 90 to 111, right? So to see them sitting at 108, it's actually one of their best years on record. Apple runs 1 quarter ahead of the calendar year, so they just wrapped up their 2024 fiscal year for tax purposes. So you'll see a cool $106 billion number right there. Very, very healthy. Now, where do we stand in terms of valuation, guys? Well, right, iPad record sales, 12% services growth, continued weakness in China. They are growing their total user base and paid subscriber base as well. 19 billion in buybacks done, 23 billion in cash flow this quarter, 108 billion on the trailing 12 months. Now, revenue growth, small, 5% per year. EPS growth, still good at 10.5%. Balance sheet, no problem at all. We took a look at that. They have tons of cash, guys, not that much debt, right? They have 100 and something billion in cash on the balance sheet, which should be updated quite soon. And then they also have a ton of cash and free cash flow that comes in. Now, in terms of the rest, if you take a look at your EPS expansion and your revenue expansion, well, EPS, they don't have a problem bringing more money to the bottom line. Yes, they do a ton of buybacks, which artificially boosts this, but Apple is very good at cost control as well when times are at a cyclical bottom right now. Now, revenue as well, slated to be increasing, but not as fast as they did in 2021 and 2022, but still nice to see them increasing. So where do we stand at 221? 33.5 PE, a little bit high for Apple, and a PEG ratio, when we divide this by their EPS growth rate, you get a PEG of 3.19. Now, even for Apple, admittedly, guys, that's a little bit high, very high in my opinion. I'd like to see this closer to a 2.5, but that's not going to happen unless the share price really comes back down to 190, 180. So you can argue that fair value is down here, but you're not ever sure if you're going to get it or not, right? I had a ton of fun buying more Apple down here, playing this trading area when Apple was cheap, but now suffice to say, Apple is somewhat expensive. So for a long-term portfolio, I would DCA slowly if you love the company, right? But it's definitely not cheap. The free cash flow yield at 3.1% as well is definitely not the cheapest as well. You'd like to see it a little bit higher, but at 3.1, it's okay. We look between 2.5% to 5%. The higher, the better, of course. So 3.1 is towards the lower end of my target range. So that's everything for Apple, guys. Decent report. I think they shrugged a lot of the worries off their shoulders right now. Yes, some lines are good. Some lines of businesses are still lagging a little bit behind, but I think they put a lot of worries behind us. My only concern is the valuation right now. So essentially for me, this stock remains a hold, right? I have a lot of long-term shares that I've accumulated over the years throughout dips, but this is not a good enough dip for me to add any to the long term. But I don't also see a reason to sell the current shares of Apple that I have. So hopefully that's insightful for you guys. In terms of technicals, we'll go over them in maybe about 10 minutes. Now, moving on to company number 3 is going to be another good one. We're going to take a look at Uber. So Uber coming out with earnings this morning before the bell, and Uber dropped 10%. At one point, we're down almost 11%. So you would have assumed that their earnings were bad, right? No, this is just once again Wall Street playing games, guys. The earnings were fantastic. When I explain to you why they're down 10%, you guys will find it as ridiculous as me. But if anything, Wall Street's giving us a buying opportunity, so we may as well take it, right? Take a look at these numbers, guys. EPS, 220% gain. Now, some of this is artificial. They do mark to market So they realized without selling some of their investments that they have in other smaller ride-sharing apps, such as Grab, for example, right? Uber likes to make little investments here and there, and those investments have been paying off very nicely. So a lot of this EPS is coming from those mark-to-mark unrealized gains on their investments, which they're allowed to do. That's a very standard accounting practice. And the revenue up about 1.82%. So all in all, looking very good here on Uber, guys. Fantastic, as a matter of fact. Now, let's jump into the article and see what happened with Uber. So take a look at this, guys. Uber reports third quarter results that beat Wall Street's revenue expectations. Let's move into the article and you'll find it as funny as me. Now, they beat expectations for revenue, but missed on analyst projections for gross bookings. Uh-oh, they missed on the expectations. Well, what were the expectations? What was the miss? Uber's revenue grew 20% in the third quarter. Company reported $40.97 billion in gross bookings. And here's the miss. 41.25 was the estimate. They missed by 0.7% on gross bookings, guys. 0.7%, right? And if you're wondering, well, the growth must be slowing down, right? Not really. Here's your gross bookings growth. Here's the percentage range, and you will see the midpoint, right? We came in at about 17% right here. That's pretty much standard to what they've been doing. Yeah, it's a bit lower than a few quarters ago, but I wouldn't say there's a crazy drop off in net bookings, right? So Uber ebbing and flowing with the direction of the economy. But in terms of gross bookings, guys, I mean, we're still at 16% year over year. And next quarter forecast is closer to 18%. Do you guys see a problem here? Arguably not, right? And they missed the estimate by 0.7%. Stock is down 10%, guys. You know what I mean? Meta, Microsoft, same thing. We see this every single quarter, guys, to where companies get unfairly hit by earnings. So it's up to you to determine whether or not it's a good buying opportunity by going through these numbers. Uber said its net income includes a $1.7 billion pre-tax benefit from unrealized gains related to the reevaluation of its equity investments. If you don't know what that means, Uber invests in a ton of different companies. A few of the names are down here. If I can find it, I should have probably bookmarked the actual page. We're gonna find it. Here you go. So liquidity positions and equity stakes, right? They have stakes in Didi, which is China's ride-sharing app, which also has robo-taxis, like Teslas, but actual robo-taxis, kind of like Waymo, but much cooler in my opinion. Grab, Aurora, Lime, which is the scooter business, Joby, and Delivery Hero. So all of those have been performing fairly well. Here is the amount of investments in terms of equity stakes that they have in the companies. So that is the moral of the story there. We are in the fortunate position of having strong performance in our core business, which allows us to make organic investments in new products and capabilities that will pay off for our platform over the long term. Essentially, what that means is we're in a position to take equity stakes in all of our other competitors. And if they are doing really well, we'll probably just assimilate those companies too, because we are Uber and we are the kings of the ride sharing business and nobody will ever dethrone us. That's what that means to me. For the fourth quarter, Uber said it expects gross bookings between 42.75 and 44.25, compared with the estimates of 43.68 billion. That's right in the midpoint there, guys. The midpoint is 43.5, 43.68, tiny little fractional percentage miss once again, and the stock's down 10%. 2.9 billion trips completed on the platform during the period. That's crazy, guys. 2.9 billion trips. Nobody else does this. Up 17% year over year. The number of Uber's monthly active platform consumers reached 161 million in the third quarter. Every month, guys, this is the monthly active users. It's massive, right? Compared to Lyft and other guys, like this is so massive. It's not even close. Up 13% from a year ago. Now, there were some rumors that they might purchase Expedia. Uber said no. They want to do smaller deals that are much more closer to home. It was a rumor circulating for the last 2 weeks. So unfortunately, they're not looking to buy Expedia. We're not looking at this point to do big deals, transformational deals, one way or the other. So here you go. Mobility, gross bookings, 17% year over year. Delivery, gross bookings, 16% year over year. Do you guys see a problem with Uber? Still growing fantastically, right? Moving on to their earnings slides, and you'll see, guys, I'll just go through the slides and you tell me where the problem is that they dropped 10%, right? Monthly active paying customers, 13%. The trips, 4%, still growing. Number of trips year over year, 17%, right? They are slowing quarter over quarter, but it's the law of large numbers, right? You can only grow at 20% for so long before the growth starts to taper off, but it's not as if their growth is getting crushed. They're growing in line with the scale of the business, right? So it's to be expected. Gross booking, 20%, right? Revenue, 22%. Adjusted EBITDA, getting more profitable as they scale. Uber was not always a profitable company, right? Take a look. If you take a look at Uber, right? They were not always a profitable company. Take a look down here. You'll see that they were struggling to maintain profitability in the last few years, right? So they were net negative the last 4 years, 5 years, 2023 profitable. And ever since then, right? Every single quarter, except for 2 quarters ago with a one-line item, they have been net profit margin profitable, and they're growing and growing and growing those profit margins as well. So nothing bad to see there. Gross bookings on mobility, 24%, with better margins expanding as well. Here's your adjusted EBITDA, delivery highlights, the delivery segment, gross bookings, 17%. Look, margin expansion there as well. So they're expanding margin everywhere, guys. Nothing wrong with this company at all. And I'll show you their net margins, right? So their net margins, I don't believe did I put it down right here in terms of the net income? Yeah, so net income right here, 23.2% in net margin. Now, a little bit of that is in terms of the unrealized gains that they had, right? So if we were to remove the 1.7 billion from those equity investments, you get net margins of 8%. Now, where does that stand for Uber's history? This is Uber's profit margin history, right? Where does it stand? Well, 8%, you'll see. It's their best quarter that they've ever had in terms of net margins. So expanding the top line revenues, expanding the bottom line margins, is exactly what you want to see from this company. So moving on further, in terms of the revenue, in terms of the fundamentals, right? Revenue growth rate, 12% per year. Healthy EPS growth rate, 30%. Looking very good for the EPS growth rate, guys. EPS, positive territory and growing, and revenue continuously growing and expanding. Looking very, very nice there. Now, in terms of your forward PE at $70, where we stand right now, 35.9, but they're growing EPS at 30% per year, guys. When you divide that by their EPS growth rate, they have a PEG of 1.2. Very fair valuation for Uber right now. And I actually cut this a little bit. It is actually 35 for analyst estimates. I cut this off a tiny little bit just to be more fair with the company because we do have a net increase from 2023 to 2024. As you can see right here, big jump, almost a 2x, right? So I cut it back a little bit just because we're coming to the end of the year. So I think that's fair at about a 1.2, 1.3 peg, depending on where you measure the numbers from. I think it's fair for this company. So guys, it's coming into my level, 200-day EMA in the support zone where we've been a few times this year so far. The valuation is good, long-term company. I will be possibly adding some long-term shares to my long-term portfolio, even though I started the positions way back here in this whole range. That's where I started accumulating Uber. No problem buying a little bit more here. They're profitable, they're going nicely. And for a technical trade setup as well, right? We're hitting the 200-day moving average right there. We're just trying to establish somewhat of a weekly higher low for possible further trend continuation. And even if we consolidate here a little bit, guys, I'll probably be going shopping and even writing some short puts because I love writing short puts, guys, on Uber in the lower to mid $60 range, $65 range. Great area to be writing short puts. So that's pretty much the fact of the matter for Uber. I like it on a long-term basis, and even for swing trading, it could be an interesting opportunity. And that's everything for Uber, guys. And now let's jump into our last company. Hopefully you've been enjoying these earnings, right? For earnings, I know I spend like 7-8 minutes per company, guys, but I think I do a good job of going through them quickly and presenting you with the best facts that I can possibly find in my outlook on the company, right? I could just give you guys the number with no context whatsoever and get through these earnings in 2 minutes, right? But I don't think that's the point of going through earnings. We want to understand where is the business? How are they positioned in relation to their past and moving into the future, right? So now let's go into MasterCard. And MasterCard, similar to Visa earnings that we looked at just earlier in the week, business as usual. Yeah, the company was down 3% and gave away all their earnings, but then again, the markets were taking a beating today. Their earnings, guys, business as usual. Is the consumer unhealthy right now? No. Take it from MasterCard and Visa, two of the largest credit card credit card companies in the world that have so much consumer data. And they're saying that for the most part, consumers are fairly resilient right now. They're not seeing a net increase in charge-offs. They don't have to give any more credit loss provisions on the company as well. Look, business as usual. 4% beat on EPS and a 1.5% beat on, you'd find be a very hard press. Look at all these earnings. MasterCard's missed earnings once in the last 20 plus quarters, right? So business as usual for MasterCard. Let's take a look at their numbers and you'll see it's just business as usual. It's just very boring, which is why I love investing in this company and Visa as well. They're just super boring. I don't need to worry about them. Profit beats estimates on resilient consumer spending. Let's move on. Better than expected profit for the third quarter. Customers encouraged by economic stability ramped up their spending. The company's shares, however, fell 2% after disclosing that the European Commission has sought documents tied to a broader investigation into alleged anti-competitive behavior in the EU. MasterCard and rival Visa are dominant players in the payments industry and have often faced scrutiny and allegations of a duopoly. The allegations are true, guys. They are a duopoly. Let's just be honest with each other, right? They are absolutely a duopoly. But then again, like they've been levied fines and they've been levied lawsuits and they always can get through them. I'm not too worried about the longevity of their business. It's just what you have to deal with when you invest in monopolistic companies, right? Which is why I like monopolistic companies. You don't have much risk from outside competition. The only risk you have is scrutiny from European Union lawsuits and Department of Justice lawsuits. Spending holds up. Spending levels remain elevated compared with last year as wage growth and hopes of a soft landing spur consumer confidence. Trends so far indicate that diversified businesses covering cards, mobile payments, peer-to-peer transactions, and value-added services such as fraud protection have been more resilient. MasterCard deserves a higher valuation based on strong expected growth in digital and international markets, which is what I always say. Companies like MasterCard, Visa, Costco, Microsoft, they all deserve higher valuations because their businesses are very consistent and very predictable. So they get the higher multiples, right? Revenue from MasterCard's payment network jumped 11%. Value-added services and solutions, 19% more than last year, and accounted for 37% of MasterCard's total revenues. These results reflect healthy consumer spending and ongoing solid demand for our value-added services and solutions. So business as usual, no warnings yet, guys. But keep in mind, right, I'm not permanent bull here. I'm constantly looking through all these earnings, through all of the macro data that we get. I'm looking for signs that we're turning the corner and we're going to fall off a deep end into a possible recession. So far, I'm not seeing it. Are these companies being too optimistic? Perhaps, right? But we will see some warning signs when they will arise. And trust me, I'll be very honest with you when I do see them. But as of now, seems to be business as usual for the major banks, the credit card companies. Consumer-facing companies are not doing that poorly. They're doing a little bit poorly, of course, but we've known that for the last 6 months, but they're not falling off a cliff, which is the important thing right here. And now take a look at this, right? MasterCard repurchased $7.6 billion worth of shares, and they have $5.6 billion in remaining share buyback authorizations right there. You can see that buyback king is MasterCard, right? And I think I actually closed the document here from MasterCard, but I wanted to show you guys the MasterCard earnings slides. Let me see if I can pull it up real quick. Let me see if I can pull up the MasterCard earnings real quick for you guys. I just want to show you like what business as usual looks for what it looks like for MasterCard, right? Let's go into the presentation right here. And there's nothing to see. There's really nothing to see here at all, guys, right? Gross dollar volume, 10% worldwide, 7% US, rest of the world up, double digits, right? Switch transactions, the amount of transactions, 11% growth. Card member growth, 6%. They're acquiring new members all the time. Net revenue, consistently up, right? Consistently up, measured in relation to last quarter, last year. Payment network metrics as well, assessments and stuff like that. Operating expenses moving up in line, but MasterCard did a great job of protecting their cash flows, essentially still very close to 50% net margins. They literally only give us like 5 slides. That's what they literally only gave us 5 slides, guys. That's how usual and boring MasterCard's business is right now. Very, very healthy earnings report from MasterCard. Sorry, just closing a couple of things right here. Very nice business as usual, guys. In terms of the fundamentals of the business, I mean, look at these net margins, right? Always high 40%, almost 50% net margins. Very good. Visas are a little bit better, but MasterCard very good. In terms of your EPS growth, consistent, predictable. In terms of the revenue growth, consistent, predictable. Nothing wrong with this business. Most, if all, the analyst targets are either a hold or a buy for the stock. We know it's benefited from a tremendous rally, which is why I was saying down here, you must have remembered me. For 2 months, I was pestering everybody on this channel. I was saying, guys, not financial advice, but when MasterCard goes into a 2-3 month period of consolidation, you don't find them often in the context of a bull market, but when they do, it's usually a good buying opportunity, especially when it lines up with either the 12 EMA on the monthly or especially on the weekly. When we dive into 50 EMA category, we don't tap it very often in the context of a bull run, right? We really don't tap it that often. And when we do, right, it's usually synonymous with a good buying opportunity. Although I know a lot of you made a lot of money on this trade and Visa, so I'm glad for you guys as well. But now, right, when we're at these highs, we got to pull back a little bit. Probably not the time to be buying when we have areas like this in the past, right? Revenue growth, 11.5% per year. EPS growth, 14%, still growing double-digit numbers. The valuation at 501, 34.5, a little bit rich, but then again, you saw what the analyst said. It deserves the higher valuation. Same thing as Visa. They deserve the higher valuations because they're monopolies. Their businesses largely cannot be touched, so they will always trade a little bit rich. The PEG ratio, 2.46. As I said, it is slightly okay for MasterCard. I like to find it on a little bit more of a dip, but they're okay. Free cash flow yield, 2.35%. Down here, guys, this was above 3%, right? Almost close to 3.3. So when you find the dips, when MasterCard dips down from its heightened valuations, you got to buy those, right? Not financial advice, but a lot of people did buy them. I bought them as well. Usually it's a good buying opportunity. Now, in terms of where we stand, well, obviously we know we're in a nice monthly uptrend right now, monthly, looking for a monthly possible higher low for further trend continuations. If we come back down here, think of the previous all-time high breakout retest, right? Nice weekly move higher. Looking for the possible retest around 490 to 477. Could be a decent little location for a swing trade, but not heavy, right? Heavy is down here. Here's just a little bit of a nibble for a long-term portfolio or for a little bit of a swing trade. And that is everything for our earnings. Wow, that was a handful. So I deserve a little bit of a sip of coffee. And now let's get into the technicals. We're going to try to wrap it up in under an hour and then do all the portfolio stuff tomorrow. So the SPY, we know we were watching this big break of this rising wedge. And I was telling you guys, if this breaks, now, admittedly, I was under the impression that we would only have a break off of bad data, but the data was good. All the earnings that I've showed you guys this week, they've all been good. And all the macro data we've all got this week has all been good as well. So market's kind of going against me. The logic behind it was good. We were looking for the break, but they broke for the wrong reasons, right? Technical sell-off, not because the data was bad. They will try and tell you that the data was bad, but the data was not bad. We looked over everything together this week, guys, right? Find me what was so bad in Microsoft and Meta's earnings. I'll patiently wait because it was really amazing, right? Anyways, regardless, we knew that if we got the break of the rising wedge pattern and we lost this daily higher low, we would be in a daily downtrend searching for weekly consolidation. We've been talking about this weekly consolidation trade now for the last 2-3 weeks on the channel, right? 5-6 weeks of rally, usually get a little bit of a pullback. And we were saying, where could we possibly go? Well, the first stop is 565 down to about 559. Now, we're not anywhere close to daily oversold conditions right now, but the hourly is completely crushed. So whenever you want to see the daily move ending to the downside, right, you need to see a change of the hourly trend. We'll be on the watch for the hourly trend to the upside. And then, because we're in a daily downtrend, we know we're looking for a weekly higher low. How do you know that daily lows, how do you know that they have a chance of getting a nice daily uptrend? When they get the hourly uptrend, watch how long it goes, and then you measure the size of the move in relation to the daily. If they can get back, right, let's say we stop there tomorrow. If we can get back 50 to 60% of the move on a nice little bounce, the bulls have a chance at being able to reset into a new daily uptrend. But if you bounce too low on the hourly and roll this over, right, hourly uptrend, and roll this over, and when you measure the size of that move on the hourly, it only translates to a 25-30% move on the daily, which is like right here, then for sure the probabilities favor the bears for rollover, and we'll be moving into this area as well. So we'll take this one day at a time. Healthy market consolidation, in my opinion. No major red flags, either from earnings or from macroeconomic data. When there will be big red flags of corporate slowdowns, layoffs, and net margins being crushed by demand, I will let you guys know. But as of right now, not a warranted sell-off, in my opinion, from a fundamental aspect. Technicals, yes, we were overbought. Now we get the correction. Moving into the QQQs, same concept, right? 5-6 weeks of rally. We were watching this rising wedge, and we were saying if it breaks to the downside and flushes your higher low, the daily bulls have now lost the daily uptrend, and we are into daily consolidation. We do not have the downtrend yet. That would be lower high into lower low. And we're looking immediately for weekly consolidation as well. So at this point, anything above 449, looking for a weekly higher low. We will see how it reacts to the level coming up. 480 down to about 475, but the bulls have a lot of space, guys. Anything above 447, looking for a daily higher low for possible further trend continuation. We will take this one day at a time in terms of the QQQs, but I will be looking to shop for a lot of my favorite big tech companies, which are currently coming down right now. Moving into XLF. Financials down as well, setting up the daily downtrend, flushing the daily higher lows. So daily downtrend is underway. And now we're into weekly consolidation as well. We know the context. Nice weekly uptrend is in motion right now. Looking for a weekly higher low for possible further trend continuation. The area of confluence we're looking at, weekly resistance, newfound support, 45.80. The 12 EMA should be running up there as well. So we'll look for the bulls to play a little bit of defense here. We will watch this one day at a time, guys. But of course, right? The whole market was down today. The whole market almost, right? So financials following suit. We'll see how it reacts down here. My favorite trades right now looking out in financials are Berkshire, which have earnings next week. If we pull down a little bit more into my support, 445 down to about 440, could be a decent little entry opportunity, guys, for looking for the monthly higher lows for possible further trend continuation. A little bit of swing trade area right here for Berkshire. And the other favorite one I'm looking at is SPGI. SPGI, extremely high quality company, going for one of my favorite trades on the monthly again. Monthly breakout, retest, and possibly run. So 475 down to about 450, possible area for some entries there. Now looking to healthcare. Healthcare, you know, surviving today to say the least, but daily downtrend is in motion right now. Inside candle. So we cannot say that the bulls have control just yet. We need the bulls to start a daily push, right? We're in an area of support right now, 148 down about 145, but we do not have it in the bag. It's the last area of defense, right? Weekly downtrend is clear as day right now on XLF. I'll remind you what we're going for. We're going for the monthly higher lows, guys. Looking for a monthly higher low, anything above 138, looking for that monthly higher low. So the bulls still have a lot of space, but we need to start playing defense on healthcare right now, pretty much. It's go time. So we'll take a look at this one day at a time as we are into now daily oversold conditions. Moving into semiconductors. Semiconductors down 3.59% today because everything was red, right? No rhyme to this reason. Most of the semiconductor names that have reported have had decent numbers. You can argue that AMD was disappointing, but we went over their earnings, guys. They are actually quite decent, right? And still the stock has been down 13-14% from that time. Nothing else, right? We went over Micron earnings a month ago. They were great. We went over TXN earnings. They were pretty good. We went over ON Semiconductor earnings, which is cyclical as well. They were pretty good. Now, Intel had earnings today, and Intel should be up about 10% in the aftermarket right now. Okay, they came down to about 7, but they were up closer to 10-12% at one point. So maybe they breathed a little bit of life into semis. But most of these earnings have shown that although we are in a period of weak seasonality for semiconductors right now, which all of these companies said that we would be in, by the way, it's no surprise, right? We are rounding the corner, and they said that 2025 should be a very good year for them. So completely somewhat logical move to the downside, but a little bit overdone in my opinion. But who am I to say where the market should head, right? So semiconductors coming down, and we got the flush. So daily loss of the daily uptrend right now. Not yet a daily downtrend because we do have a high here. So now we would need to set up for the lower high, lower low for a confirmed daily downtrend. But one thing's for sure, right? With the big move down like this and overhead resistance, it's not looking the best. 261 down to 250 resistance. If we pop back up, maybe just looking for a lower high into lower low progression. And already, even though we don't have the daily downtrend, we are into weekly consolidation because we flushed the last 2 weeks worth of lows. So as predicted, we are heading for weekly consolidation. Next area of support, we're coming into it, 238 down to about 230, which is the preferred zone. And the way that I want to play this is by writing short puts on my favorite companies well below their current market prices. And there's a lot of decent opportunities in that sector right now, which we'll look into in just a few short moments. IWM also coming down. IWM just not liking the market today. Tough for them to run when everything else is red. We're almost flushing the lows. If we lose these lows here, guys, daily downtrend underway. And unfortunately, we look to further weekly consolidation, lose the 214 level. Weekly uptrend is lost, and we may find some base of support here, 213 down to 207. But as I was saying, guys, it's so tough for the Russell to break this level of resistance up here without an overall green light from the markets, right? So very possible we continue down into here. I may be looking for some positions in this level, still uncertain, but at the current time, it's equidistant risk to reward, right? Basically a one-to-one trade up or down. So I'm looking for better risk to reward metrics in the lower area. Lastly, the Dow Jones also pulling back. No surprise there. The whole market is, right? Daily downtrend continues to be underway on the Dow Jones. Not yet anywhere close to daily oversold. Wouldn't you want to see this daily move down, bottom out? Look for the reversal of the hourly uptrend. We have had no hourly uptrend this entire time. So if you're looking for that daily bounce, watch for the hourly uptrend. If not, we will continue this daily downtrend into an area of support, which is going to be down below us. 41.3 down to about 41,000 is going to be that level. We broke through our support zone right here, broke through it today. So the next area is that green box. Once again, what are we looking for on the weekly? Weekly uptrend, very nice. Looking for a weekly higher low for further trend continuation. So this area is a likely area of a reaction zone for the Dow Jones after they will possibly be down 4 to 5 to 6%. The Dow Jones does this many, many times throughout a given year, pulls back 5-6%. In my opinion, as of right now, at least, still just a healthy correction, right? Now, in terms of yields, of course, have been up today ever so slightly because we keep getting good economic data. So the soft landing scenario is still on the table, but I'm pretty sure that yields are starting out the rounding of the bottom process potentially, right? Daily MACD is looking like it's curling. We've been oscillating between daily oversold and not. We know we have a big support area on TLT down here. So very possible that we embark on somewhat of a rally on in bonds as a whole. Obviously, if we keep selling off in the SPY and the QQQ, the fear will come into the market. It may prompt people to start buying up these bonds because these yields right now are attractive. Keep in mind, the Fed is cutting rates right now. And since the Fed cut rates, the rates are up 0.5%. So maybe you got some bond traders or some everyday folks looking to lock in these yields while they're high, especially if more fear comes into equities, right? So that could be a little bit of a rally catalyst for your TLT and a little bit of a, because there'll be demand for bonds, it might push your yields a little bit back down, right? But in my opinion, guys, we may, even though we might get a short-term rally, I'm not expecting something like this, right? We may just stay somewhat muted on the TLT and range bound as we move through this very complex trade, which is the bond yield trade right now. We'll keep you guys updated on a day-to-day basis, of course. Now moving into Bitcoin rejecting from pretty much the all-time highs, right? We did put in a fractional new all-time high by just a few dollars, as a matter of fact. The daily uptrend is still maintained though, right? Very nice daily uptrend. If you were to remove, right, the moral of the story, right? Nice daily uptrend. If you were to remove this little area right here, technically speaking, this is the actual daily uptrend, right? So we'll take it from here. Daily uptrend is nice. Looking for a daily higher low. We're now slightly above. We didn't really crack it to the effect that I wanted to. I'm not going to put this box green until we close a weekly candle above this box. So as of me for right now, it's still longer time frame resistance, right? Monthly and weekly resistance, but the daily is not looking too bad, admittedly, right? So reacting from previous support right there, coming down possible 12 EMA, a lot of space still. But if we roll this over, guys, what are we going to be looking for? Looking for weekly consolidation, right? At this point in time, anything, this is a big weekly move, right? Weekly uptrend is very nice. So at this point in time, what we're going to be looking for, anything above 59.4 is just going to be looking for a weekly higher low for possible further trend continuation. The monthly MACD does look quite good. So we'll see how this trade pans out. I'm still very bullish on Bitcoin. My favorite way to play it is by writing short puts on BITX, even going with some shares. Call options up here, although they can be beneficial, slightly risky, especially when we have weekly consolidation on the SPY and QQQs. Now moving into big tech, we're going to go through these a little bit quickly. So Apple coming out with earnings, of course. Now they stand at the 222 level. So we're approaching our area, guys. Daily downtrend flush through this big zone of support, right? We're now going to be approaching the lower area of support, 219 down to 215. We will see how we react to this zone. It's been a level of support since June a few times. So we'll see how it reacts to that area specifically. As a whole, on the weekly, unfortunately, we will be sacrificing almost, depending how we close tomorrow, we may lose the weekly higher lows, guys. If we lose the weekly higher lows, probably just heading into extended consolidation. And you do open up the door for the bears to do something like this, but that's a long ways away. We'll take this one day at a time. As of right now, for me on Apple, no swing trades yet. I would be really interested if we push down on Apple. I'm really interested, guys. 210 down to 200 is going to be my desired range for any short puts or short-term or call options or things like that. The valuation is a little bit too high for me right now. We'll take it one day at a time. You can none of this is financial advice, right? There is a small little bounce trade that's possible to be had right here, guys. Not my favorite. I would rather wait for my desired target levels. Moving into AMD. AMD down another 3% in the after hours today. We know that the daily bounce was sacrificed. Big time daily downtrend follow through right there. And now we've lost also the area of support. Big area, 162 down to 154. So we just continuously move towards this big support zone below us, right? We know, unfortunately, now the weekly uptrend is not looking the best, guys. The bears have taken back a ton of this move. They've taken back almost 78%. So we know the best case scenario for the bulls at this point is probably not the V shape because the bears have taken back too much. The momentum is kind of dead. So if anything, they may just have to have a range of consolidation a little bit, build up some momentum, and make an attempt at breaking this level once again. Below us, though, is a decent area for writing short puts. We're coming into it now, 140 down to 125. If we get continued volatility, I'll be able to write probably $10 below the current price for some decent short puts. The valuation below in the 130s and even high 120s is quite attractive for AMD. So the way that I play this, rather than trying to time the bottom with some calls and stuff like that, before we have a clear daily uptrend, right? Before that happens, the way I'm going to play this is by writing options down below here. Best way to benefit from the volatility, in my opinion. And if you end up with the shares at a good price with daily oversold, maybe you can benefit from a little bit of a bounce as well. Moving into Amazon. Amazon down 3.28% during the day, but of course, they have erased that gain or loss rather in the after hours. Still going to struggle though with the 200 psychological, the Jeff Bezos wall. Every time we hit this area, guys, Jeff Bezos sells into us. He's using us as exit liquidity. So we'll see if we can break the 200 psychological wall, and that's just the fact of the matter. That's the next resistance. But as a whole, though, guys, what have we done today? If we open like this tomorrow, daily uptrend, we've actually come through this area of resistance, 190 to 188. We know it's been plaguing us quite a few times over the past year, right? So now that we're through it, we'll see how prices respond. Is Amazon going to give back all of its gains like Google did, or can they maintain? That is to be seen, but one thing's for sure. Now, if we start back testing this area, especially after these crazy good earnings, if we start back testing, I will be looking to write some short puts and maybe even go with some call options with a lot of time on them, right? For possibly mid-2025, maybe even end of 2025. For possibly some leap call options, because I love the earnings and I love the way the company is moving in terms of focusing on net margin. So that's what we're going to be looking for Amazon. Moving into Google. Google giving back almost all of the earnings move. Is that bad, guys? Not really, in my opinion. Yeah, it sucks that we sacrificed a lot of gains that we had, but still, I love the earnings for this company. The valuation remains cheap, and I think this is just some overblown sell-off with the rest of the market right here. They still do have a decent amount of space, guys, but as long as we do not close a weekly candle above this area, I cannot put this box into a green area of support. So daily higher low is here, 162.81. We're going to look to set up the daily higher low to possibly continue this daily uptrend. We'll see what happens on the weekly. Same thing. We do have the weekly uptrend right now, but Google needs to have a quite good day tomorrow because this candle is looking kind of ugly, right? But the inverse head and shoulders pattern did play out with those earnings. So, we had some good gains on the week. I had some short puts down here, took profit on those. I have a leap. We've given back a decent amount of profits on the leap, but we're still up. I got my leap down here, guys. And if we come back here for any which reason, once again, I'll be writing some short puts and I'll be probably buying some either call debit spreads or adding to my leap position because I love the company's valuation right now. Very solid. Moving into Meta. Meta down 4.09% after their terrible, fantastic earnings, right? Anyways, we did them yesterday, guys. Just go have a look, right? So Meta down about 4%, still not flushing the lows. Meta, even after their sell-off, they're at levels not seen since last Friday, right? Not too long ago. We'll see if they lose this move, guys. They'll lose the daily engulfing move and we'll forfeit the chance at a daily uptrend conversion. If we lose this, suffice to say they lose the daily uptrend, you open the door for the bears to do this, continue the daily downtrend, and just continue the weekly consolidation, right? This is not a weekly lower high into lower low. We never confirmed a daily uptrend. So you cannot say that this is a weekly lower high, or in my opinion, this is just one leg down of weekly consolidation. So the analysis remains the same. Nice weekly uptrend, looking for a weekly higher low for possible further trend continuation. And if we come down here, guys, 540 down to 530, you guys know what the drill is, right? One of my favorite trades, the breakout, retest, and possibly run. Valuation for Meta is quite decent right now. Crazy free cash flow, crazy net margin. So I will be a buyer down here on Meta, of course. Moving into Microsoft right now. Microsoft down 6%, their worst day in over 2 years because of their absolutely terrible earnings with record amounts of free cash flow, record Azure growth, right? Terrible earnings from this company, of course. Growing double-digit growth for the next 3 years at a $3 trillion company valuation. Such bad earnings, right? Revenue growth down 1.8% because they're constrained on their own demand, not because, because they're constrained on their own supply, not because demand is weak, right? So, got to take these headlines with a grain of salt. Buying opportunity, in my opinion, for Microsoft, guys. Not quite daily oversold on the daily, but we are coming into oversold on the 4-hour time frame, and hourly time frame has been crushed pretty much all day. So we'll wait, right? When you want to see the daily bounce, coming into a big area of support, guys. This is my leap call territory. I bought one here. We're down about 5% on them. Big deal, right? If we come down here a little bit more, I will be adding to those leap call contracts. 400 down to about 390 is my sweet spot to add a leap down there. Has been support area for the stock the entire year so far, and we're flirting with the 200-day moving average right now. So not looking too bad, but then again, we did kind of undo our weekly uptrend momentum right there. Unfortunately, we got an equal high, right? You can call it lower high, weekly downtrend potentially. The company is just consolidating sideways on the monthly. So it hasn't moved all year, even though the company's been improving their fundamentals all year. That's why I love this range of accumulation, guys. When a business has been moving sideways for a year at this point in time, but improving their fundamentals, well, sometimes you get some nice pops like Visa and MasterCard have shown, and even some companies like Costco have done in the past too, right? Sideways accumulation for about a year, and then their fundamentals are getting better and better, and then they just eventually have a massive rally, which is kind of what I'm expecting from Microsoft too. My end of 2025 target for the stock is in the 500 range. 500 to 550 seems fair to me. Moving into Netflix. Netflix, acting like nothing even happened today. If you only looked at Netflix, you would have no idea what's happening in the markets. Up a cool 0.3%. Still consolidation sideways on Netflix. If they break these lows, 746, let's call it, daily downtrend is underway. And at that point, you just look for some very healthy weekly consolidation on the stock. Tons of space, anything above 662. Just looking for a weekly higher low for further trend continuation. So if Netflix gets caught up in this whole market sell-off right now, I will probably go shopping for a bit of the company, maybe some call debit spreads, something like that, something light, because my heavier buys usually come down in here for monthly higher lows. But if we come down there, guys, you know, let's call it 720 for the earnings gap fill, all the way down to roughly 700, 690. Decent little opportunity, in my opinion, for some call debit spreads, something like that. And if we just continue pushing higher, you guys know the drill. 800 psychological resistance. But the bulls are looking good. No red flags. NVIDIA down 4.72% today, even though, this is why it's so funny. One of the criticisms of big tech earnings this entire week so far has been how much money, even though it came in line with guidance, Meta said they'd do a little bit more next year, but most of this CapEx spending on data centers, on AI graphics cards, right? All of these companies have been saying we're raising capital spending in line with estimates, but they are still raising. Where's all this money going to? It's going to this company right here, NVIDIA, right? And AMD. And they're basically telegraphing that AMD should have good earnings, not only for this year, but next year as well. And still, this stock is down 4.72%. Daily downtrend. So daily downtrend underway. You guys know the drill. We were talking about this. Weekly consolidation is underway. Anything above 102. Looking for a weekly higher low for further trend continuation. There's a little bit of a swing trade right here at 130, 126. If you're more aggressive, right, for possible to set up the weekly higher lows for a weekly trend change, but you need to watch the daily, right? How does it pull into this area? And can we get some shorter term time frame shifts as we pull down into there? A little bit of a swing trade here, but my preferred area is all the way down here, 119 to about 115. That's a very decent level for NVIDIA. We'll see how they react to this one first, but this is the deeper level where I'm really attracted to position for some shares, maybe even some call options leading to their earnings, which is in 3 weeks worth of time. So sell off, yes, but who's in control here? The weekly bulls are still clearly in control. Moving into Tesla. Tesla down about 3% on the day, pulling back, completely logical and normal move. They got rejected at 265. Been a pain point for the stock over the course of the entire year so far, quite a few times, right? Pulling back with the overall market. Fantastic earnings, but pulling back, looking for a daily higher low. Anything above 213, looking for a daily higher low. I'd be targeting this area down here, guys. 240 to 235 seems to be the area that Tesla wants to target on the daily, but also on the weekly pullback as well. Looking for a weekly higher low. Weekly uptrend is nice right now. Looking for the weekly higher low for possible further trend continuation. There's so many other better opportunities than Tesla in terms of valuation right now. So Tesla's not my first pick. There is a little bit of a swing trade to be made right here. If we come down here, there might be some short puts available, 220 or better, but I'm focusing a lot of my buying power on the rest of big tech, which have a lot cheaper valuations right now, but Tesla not looking too bad, all things considered. And lastly, Palantir. Finally, to the detriment of the bulls, of which I am included because I have a ton of shares, guys, in the lower $11 range. So I don't want to see this stock come down, even though I did have covered calls, which are doing nicely right now. Down about 5%, and this was inevitable, right? I was telling you guys, watch when they lose the 12 EMA guide, watch when they lose the daily uptrend by flushing the higher lows. That happened today. So 5% to the downside, Palantir now down a total of roughly 8% off the all-time highs. And when you lose the daily uptrend, what do you know is going to happen? Probably or possibly a daily downtrend location. We have earnings next Monday though, so not a lot of action before earnings, right? In the event they pull back further, you guys know the drill, right? Looking for the weekly higher lows for further trend continuation. Now, all of these companies have had fantastic earnings so far, but they've not been able to keep them. So what do you think is going to happen to Palantir if they report inline earnings and inline guidance after such a crazy rally? They're probably going to come down if any of this is any indication, right? So that being said, if we do come down into this location, guys, 39.38, looking for the weekly higher low, I'll be sitting there writing some short puts. 35, 34, 33 is where I want to acquire a bit more stock for some swing trades. And that is just my, my analysis on Palantir. I did take an earnings position on Palantir, but we'll have to wait for that in tomorrow's video before the close. They have earnings Monday afternoon. So that's pretty much everything for our stock analysis today. Hopefully you guys appreciated that. A lot that we covered, right? So I hope you appreciate, even though I know my videos are long, guys, I apologize, but it's not as if I screw around in these videos, right? I'm just giving you like numbers and analysis constantly. It's not as if I'm looking for my words or stuff like that. And I talk fast. So hopefully you guys appreciate these videos, even though they might be a little bit long. If you did, consider dropping a like, would appreciate it for the growth of the channel. Also consider subscribing to the channel if you're new. We do these every Monday to Friday after the close. And lastly, if you have any questions at all, now's the time, guys, as we are embarking on correction mode in the indexes. Leave your questions down below and I'll be happy to answer you. And as a whole, if you ever want, as I previously said in the video, if you ever want access to my trades in real time, our private market morning live streams where we prep the trades, go over your guys' trades as well. You guys can also, in our chat rooms, ask me for feedback on anything you want all throughout the day and have access to many, many more features. Check out the link down below to the Discord. It'll give you a better indication of what to expect. And that is pretty much it, guys. Take care. Be safe tomorrow. Still 2 remaining data points, but we're all through our earnings. So congratulations, you guys made it through. And next week, we really don't have too much. So that's it, guys. We're now through the earnings season. Hopefully you guys had fun. Hopefully you guys have cash to buy the dips on companies that you love. Or if you just don't trust the market and you want to wait for better prices, do that too, guys. Whatever you guys like, just be careful out there. Be safe. Have fun. Do it with a smile on your face, guys. Right? Pain in the markets is the time that you have to buy. So just take that for what you will. This has been a pleasure once again. I will see you tomorrow after the close, and peace.